We're very thankful that you could make it this morning, and we hope everybody stays healthy and in good spirits. This morning, we're going to have a great discussion moderated by Michael Stoller. And I want to thank Michael and Ty Burns and Nadir Settles and Joe Fingerman for joining us today and sharing the views of the market. Before we start, I'll provide a few minutes of presentation of what we at Ariel Property Advisors are seeing in today's New York City investment sales market, the challenges, possible opportunities, and where we think we will be down the road. Before we start, I invited our good friend James O'Neill, who's the Executive Director of Legal Outreach, to give us a few words about what the nonprofit that caters to students and to essentially kids after school program, what the nonprofit does during today, and what can we as real estate executives can do for the nonprofit that that allows the students to learn about real estate through Zoom and other venues. James, thank you so much for being here today. Please tell us a little bit about what's happening with legal outreach today and how can we be of help.
Certainly. So let me just start off by thanking you, Shimon, for once again having legal outreach be a part of this. To manage this crisis, it's important to keep the faith. To keep striving to not only maintain the status quo as a community once we've reached the downside of this crisis. So in that light, I want you to know that Legal Outreach as a college prep organization is continuing to do its part. We're implementing all of our skill building and exposure programs remotely. And most importantly, we continue to serve as an anchor for our students and their families who are suffering through the effects of the pandemic and the economic downturn. Based upon surveys administered to our current students, it's been reported that 58% have a parent that has lost a job, and 28% report that a parent has been deemed an essential worker, which of course places them at greater risk of contracting the virus. About 12 kids have reported that a parent or guardian has actually contracted COVID-19. So these personal home situations combined with remote learning challenges make it imperative that we at Legal Outreach continue to serve as a light and a beacon of hope in the midst of darkness. But we can't do it alone. We need your help, and here's how you can assist. Our desire is to work with real estate companies, starting with Ariel Property Advisors and those who are panelists, to launch our new professional exposure program known as PEP. We're asking you and your companies to give only 1 hour of your time to talk remotely with a small group of 15 to 20 students via Zoom or any other platform about the work that your firm does in the context of the real estate industry, whether it's as a buyer, a seller, investor, broker, lender, etc. We're not seeking financial support for the program. All we're looking for is 1 hour of your time as we expose our students to and immerse them in the world of real estate during the weeks of June 15th and June 22nd. So there's plenty of time to prepare. During that 10-day period, we can plan for your company's presentation anytime between 10 a.m. and 6 p.m. on the day of your choice. For those who are willing to work with us, please provide your name and the name of your company to the host using the chat feature at the bottom before the end of today's Coffee and Cap Rate session. In the alternative, you can contact Tamika Edwards, whose contact information is listed on your screen. She'll be in touch to arrange a specific time to talk with everyone who signed up about the details. So again, thank you so much to Ariel Property Advisors and all of our panelists, and to all of you who are doing your part to keep hope alive during these challenging times. It's much appreciated.
James, thank you so much. You're doing great. And I wanted to repeat what James said. Yvonne, if you could bring the prior slide so everybody sees Tamika's information. It's 1 hour. You're going to talk to the students online about what you do. Pretty simple. Please, that could help us a lot. That could help the students a lot, exposing them to the real estate industry. So thank you, James, for that. We're going to talk a little bit about the current state of the market and then jump into the panel discussion. So the first thing that we're going to see is the first quarter activity in New York City. We've had a decline of 22% in dollar volume to $7.4 billion only, and 15% when you look at transaction volume. The month of March surprisingly was good just because there were 2 outlier transactions in the beginning of the month. What does that tell us? It really doesn't tell us much about the current crisis. If you remember, COVID-19, which we all do, started in the middle of March. And so the effect on the first quarter, or COVID's effect on the first quarter, was almost meaningless. It wasn't meaningful. And that means that we got into this crisis with a low amount of transactions as it is. What we're seeing now, and what we're seeing moving forward, is some challenges when it comes to contracts that were done prior to COVID-19, prior to the month of March. So some reported transactions where buyers walked away, 900 3rd Avenue and the Daily News building as just examples of these two. Many transactions that are currently in contract are being adjourned 60 and 90 days. So that means that they'll probably close, but there is about 1/3 of those that are closing today. Takes longer to close transactions. There are title company delays. There are appraisal stuffing schedules that are an issue, and the city is not fully functioning. The lending environment is challenging. That's not a secret, and Joe can tell us more about it soon. Lenders are overwhelmed with different programs, including the PPP right now, and that's their first focus. CMBS lending is on hold, and there are many lenders who are currently pulling back on underwriting retail income, which affects both the retail market as well as mixed-use properties. The active buyers in the market are 1031 buyers that are looking for product, rescue capital, opportunistic capital, and as we move along in the next few months, we'll see more activity in that sector, and affordable housing capital, specifically for project-based Section 8, that was really not affected collection-wise by the current environment. Asset classes impact in terms of collection. Retail pretty much impacted the most, together with hotel and office. From our survey, from what we've discussed with investors and owners, about 30% reduction in collections, 30% collections in retail. Clearly the hotel market is not doing great. 80%, the occupancy rate fell by 80%. Office collections, we're told, is 50% at best for B and C buildings. Maybe it's a little different on A buildings. The co-working industry is really affected the most, as short-term leases are not necessarily renewed. In terms of asset classes, the multifamily asset class is doing relatively well, especially when it comes to free market. About close to 90% collections for the most part. We don't know what's going to happen in May, but that's what we're told in April. For rent stabilized multifamily, especially in the boroughs, collections are lower, as low as 50% in some cases. And what we're really looking to see is what's happening in May. Development, larger development sites are on hold. Pricing is unclear, mostly because construction lending is not there. When I say construction lending, I mean conventional construction lending, not bridge or private construction lending. So really on hold with that, and the warehouse industrial market is doing pretty well and stable and in this market. Lending environment, bridge lending is still there at pretty much higher rates, but still there. Permanent lending, less so. Joe can talk about the balance sheet lenders. We know agency lenders are providing financing at higher interest rates to mitigate the risk compared to prior to the crisis. Macro perspective, the Fed is not a secret, pouring a lot of money into the economy today. And that is going to, we believe, contribute to a pretty big comeback that will probably start taking place not before the fourth quarter of 2020 and probably throughout 2021. On a micro level, one win that landlord had during this crisis is the appeals court ruling on the housing stability law of 2019 when it comes to a look back for rent stabilized overcharges. So what should we expect? The biggest question mark is May collections, and that's a very short-term question mark. We can expect very little transactions in the second quarter of 2020. If we had to predict, probably as low as 2009. Just to remind everybody, 2009 was a $6 billion year, probably about a 10% year comparative to anything else we see. Possibly very low quarter in Q3 as well in terms of volume of transactions, which means that pricing will stay somewhat stable during the second quarter through the third. Downward pricing pressure will be there through the third and fourth quarters, especially retail, office, hotels. Fair market multifamily, free market multifamily will probably not be affected as much pricing wise as we believe about 6 months after we move back to normal or to somewhat normal. Prices and collections will come up. Rent stabilized multifamily, especially in the boroughs, will be affected pricing wise moving forward. Affordable housing Section 8, as I mentioned before, is expected to do extremely well during this environment and possibly after, just because collections there are certain and there are other features within the contract that make it attractive. That summarizes my part of the presentation and what we see in the market. We hope it was helpful. I want to hand it over to our friend Michael Stoller to introduce the panelists and to start a discussion. Thank you very much.
Thank you, Shimon. It's close to 2 months ago that we had the same group of gentlemen sitting with me at the Club 101 and talking about the world. We didn't talk about COVID. We didn't have any of the changes, but the world has changed quite a bit. So I'm fortunate to have Ty Barnes, the VP at Taconic Investment Partners, Joe Fingerman, our favorite banker, Managing Group Director, and Senior Vice President Commercial Lending at Signature Bank, and Nadir Settles, Managing Director, New York Regional Head for Office Real Estate for Nuveen. So Nadir, your camera's back. You got to move you so we can see you again. Okay, back over there. So here, in February, we were talking about, we had terms called opportunity zones. We had different ideas. We had development opportunities. People were saying, there are still opportunities in different parts of the city. How do you look at it today with regard to the world, okay? Has the subject of opportunity zones come to both of you in transactions, or that has fallen apart temporarily? Nadir, Ty?
This is the first time I've heard the word since probably definitely the last month. So opportunity zones, I haven't heard about it in a while.
Right. Nadir, you're in a similar venue, I'd say?
Yeah. And specifically due to the tax benefit of opportunity zones, we just haven't pursued that and focused on it just because our capital isn't aligned to invest that way to receive those benefits.
Shimon, put your microphone on. We want you to be part of the conversation. You know, when your team was out there at the beginning of the year and the end of last year, when opportunity zones was a big subject, today, when you're closing transactions, are you closing any development transactions, any land transactions that were
We
in?
have a few land transactions that are in contract right now. Most of them will be deferred 60 days. One interesting point about opportunity zone is that we have a deal in the Bronx, a smaller deal in the Bronx that is in an opportunity zone. And we have an interested party and a contract out for that one, even during this time. So in some cases, in special situations, when someone has the tax need and wants to take advantage of the tax code prior to year end, you'll see it happening even today. In terms of opportunity zone, we've seen a lot less activity and talk about it this year compared to the year before.
Okay, Joe, you're the lender. You're the guy that everybody wants to know what's happening. So what's really happening? How's your appetite today to lend money as compared to 60 days ago?
Thank you, Michael. A couple of things. First thing is obviously we are experiencing on the borrower side several people having difficulty with collections. So we are focused right now on forbearances. We're focused on these SBA payroll loans. And then what we're also looking at are for existing clients, we're willing to look at deals. We're not looking to take on new clients. We're not doing any land or construction, income producing properties, moderately leveraged. And if you're a client to Signature, we're here for you and we want to work with you. So
here's a question for Ty and Nadir. You know, 2 months ago, 5 months ago, you were active looking at transactions. Today, both of you are involved with acquisitions and investments. What are you trying to do today? Are you trying to analyze the investments that you made before, or are you looking at any opportunities today in your own mind because maybe land is less expensive? Maybe you can buy a building, as Shimon just stated, certain deals fell out of transactions. Where do you see the opportunities for two companies who are investment business? Ty, Nadir?
You want to go? I'll jump in there.
Sure. So, I focus on residential, so that's what I can speak to, Michael. But in general, it's really difficult right now to not know what collections are going to be in May and June to really value an asset. Are vacancies going to go up? How much should I be underwriting for bad debt right now and then into 2020? I don't know that answer right now, so it makes it difficult to evaluate a deal. We're still looking at a lot. I think that I saw more deals cross my desk in the month of February than I can remember for any 1 month in the last couple of years. So I think that sellers do want to move their product. I don't know if the bid ask is where it needs to be. And I think the bid ask needs to be reset. I think that there's a paradigm shift, not even just because of the law changes last year for the rent stabilized product, but now with COVID, and there's still an Albany effect too of what's going on. There's some talk about modifying some of the ways that rents are going to be collected. So that affects things too. So it's a wait and see right now, but we're still looking at a lot of deals.
Nadir?
Yeah, I would echo similar comments there. So on the commercial side, one, the focus is just stabilizing the operation, right, and getting rent collections, working with our tenants to ensure that we're sort of responsive to their request and working through what sort of rent deferment looks like. On the acquisition side, as we want to be active, and we are active in the market. So I'd say with 2/3 defense, 1/3 offense, and we're keeping our head on that swivel. I think we got to be patient for opportunities to work their way through the system and get sort of post-COVID pricing. That doesn't come 6 weeks after you fall into a crisis, but we are getting organized and just starting to think of places where we think that disruption may occur first, and how does that sequence? So the first place is sort of the distressed debt space. maybe we start to look at some opportunities there, start to look at opportunities where co-working was an exposure to some assets. And then you start to see sort of price and dislocation as you get further into the crisis, and then we can evaluate those opportunities.
So, you bring up the term co-working. Shimon brought up the term co-working. What's the feelings of all of the people, on here with regard to the future of co-working? Okay. Especially, with social distancing, with everything over there. Do you see, Regis has been in business for many years. They've continued. Okay. We know what's happening to WeWork, but what do you see about co-working in general? Joe, you're the lender. Would you lend on a property that has co-working today?
If it's Michael, if it's one portion of the income, maybe they rent a floor or two. I don't know that we would do it right now for the entire building. Certainly WeWork has had their problems. From a management point of view, from the bank, we've had difficulty keeping employees healthy, keeping employees, in the office. Most of us are now working remotely. And I just don't see the desire to run to a WeWork or a Regis facility where you're on top of each other today. I think the offices are going to get bigger. I think they're going to be staggered work hours. So it's a little concerning, the whole business model right
now.
Ty? I'm a residential guy, so I default to Nadir.
Yeah, so I'll say on the co-working, there's definitely a disruption in the business model as far as the density, how they sort of encourage close proximity, collaboration, whether workspace or other sort of common areas.
Share the coffee cup, share the beer mug.
In breakout spaces. So I think definitely there will be a correction to the model, but is the business sustainable around short-term leases in a way that comes with some sort of concierge service? Sure. Some of those folks will survive, and that business model will still make sense to people that want to take that sort of real estate aspect out of their decision-making, right? I run my business and I run engineering business, and so somebody else can help to be my real estate solution, and it can be a one-stop shop. So the business model and the thinking behind it and the demand, it will continue. I think the actual how co-working in its current formation will change, and so that changing is going from, so what Joe mentioned a little bit, from higher density to the layouts of those spaces, and then there's probably going to be some consolidation. So there's not going to be, there's so many players. Some of these names that come across, I didn't even know that was a co-working company. So there'll certainly be some consolidation, and the stronger guys will survive into what will be version 2 of that business.
Okay, Ty, since you said you're the residential guy, what do you think about the future of co-living?
It's, similar to you said, sharing the beer cup, sharing the coffee mug. If that's part of it, then I think cleaning companies are going to do very well. There's still so many unknowns. I'm not a doctor. Once a cure comes out to this thing, I think that things can return to normal much quicker. But to not know, unless we have a cure or some sort of a shot similar to a flu shot, I don't even know if that's doable. But if that's the type of solution, so it turns into COVID being similar to a flu, then I think that those types of businesses can go back to where they were. I just don't know. But I think our scientists hopefully will figure that out quickly.
Joe, this is a question from Mr. Fingerman, our lender. In the past, certain banks were looking at the co-living environment, where they were getting higher rents for the apartment. How do you look at co-living today in the future?
It's not something that we've really ever focused on. I think it's something that we always look at any of these scenarios where they're not leased to regular tenants, where it might be a group or a company. We look at what the market could bear and lend at that number. So if you have a 3-bedroom unit that a co-working company is going to pay $6,000 for in Manhattan, and we believe the market's $5,200, that's the number we're going to underwrite to. We don't like to look at, temporary ways to really increase cash flow. So we try to look at the fallback scenario in those cases.
So here's a question with regard to rents, collections, and everything. You know, many people have their rent payments taken out on an ACH or direct withdrawal account. So April came early. You know, the crisis began in the middle of March. The city really closed down about the 17th or the 18th. Now we're close to May. What do you really see as potential collections with regard to the office market, which you have office tenants, Nadir? Ty, you have different type of people in your residential rentals. Joe, you see as a bank because you get certified rent rolls. What do you really think we're going to be able to collect coming in May in the different asset classes? Nadir?
So I would say it's hard to speculate on where that comes. What I can give is some of the sort of the points of where we're at sort of in April. And so we've collected on our New York portfolio 92% of rents. And so do we expect some deterioration from that? Yes. How drastic that is, it's hard to tell or hard to speculate. And we'll sort of have to address that upon getting to May. But you know, we feel like we got high quality tenants. We're working with them, and you know, hopefully our number maintains.
Ty?
Michael, oh, sorry, go ahead, Ty.
Michael, just a quick sidebar. Like I know I shut down a couple of my automated payments for ACH for, I guess, transactional things in my life. And I think a lot of people did that. So I've heard a couple people mention your comment that people didn't shut down their ACH, but I think that's one of the first things people did. So I think that that's kind of baked into the April number as well. As far as May goes, it's I think it'll be a little bit down from April, but I made some wagers with some friends for, let's just say I lost a couple bottles of bourbon betting against friends for where I thought collections were going to be, and I'm glad because they were higher than where I thought they were going to be. You know, I thought we'd be around 55% for April, and I'm very glad that we're pretty much on par with where we were previously for months pre-COVID.
Michael, couple things. I think the first thing is, I think one of the things we should discuss is what is going to happen, right, in Q4. I'm curious to see what people think about that, because clearly we're all on a standstill right now. We're talking about collections for May and possibly for June, but at some point, things will go back to somewhat of a normalcy. And the question is, what's going to happen then? That's one. And two, I wanted to invite to this conversation my partner, Zick Sozio, who interrupted us before, also to chime in. So with that.
Thank you, Shimon, and good morning, everybody. And I'm so sorry about the interruption earlier. And I'll just say that at least you couldn't see me, because that would be kind of scary if you saw what I look like right now. So at least you just heard me and didn't see me. But you guys look great. But to Shimon's point, I think one of the things that I'm curious about is, as we go forward and as the economy potentially opens up in the months ahead, is how has this changed your return requirements, right? And maybe let's drill it down to, I mean, clearly there's returns over the life of a deal, but just going into a deal like Ty, for instance, right? When you look at a rent stabilized multifamily portfolio, and a lot of the moving parts that come with it in today's market, what kind of cap rate, what kind of cash on cash return are you going to be seeking going forward, and how does that differ from what it was prior to COVID?
Sure. I think that as I said earlier, I don't think the bid ask is there yet, but a lot of it goes into what I'm interested to see what the Rent Guideline Board does today, honestly. I took a couple notes down before we started, and that's actually the top of the list for the rent stabilized world, because it affects the full spectrum. It affects 421A buildings, and it affects rent control buildings in the city. So what RGB is going to do has a really big impact on that answer, Vic. The other one I think is bad debt, is that, I think that there's a perception in the media that a lot of landlords are going to be evicting people And that's one of the reasons they're asking for some safeguards. But I think that that's a small percentage of landlords. And like most industries, I think a lot of landlords want to do the right thing. So for that, I think that there will be some workout situations with tenants that are having issues paying rent. I think that a lot of landlords are doing that. And so going forward to underwrite a deal, I think that it's going to be really low on rent growth if there's any for the first year or two. And, for the exit part of a deal, if it's, cap rates are definitely going to increase to where they were before. It's a new paradigm, like I said, and it's the way that we underwrote deals and looked at them, I think are going to change. And it's a combination of what happened in June and potentially what's going to happen now. So the range for cap rates, I think, are going to expand significantly.
With regard to that, what do you believe cap rates are today, and what will they be in the fourth quarter?
Come on, Michael.
Come on.
The tough part is, the tough part is, Joe can answer that. I think the tough part is that I think that right now appraisers, which are going to affect debt, are not putting, since there have been very few transactions of institutional grade of like 50 plus units, they don't have them. So they're using discounted cash flow numbers instead of sales comps for recent deals. So they're kind of pulling those numbers out of the sky. I think some are saying a discounted cash flow could be a lot higher than what I think a true cap rate would be. So the fact that there haven't been many transactions makes it a little bit difficult. But, it's for some of the outer boroughs, I think it's, they've definitely seen some uptick in cap rates.
Why don't we ask the source? Because, Joe, you're doing loans. You're not closed. You are doing loans. What are you looking as today when you look at a deal with regard to a cap rate, debt service coverage, and loan to value?
So cap rates have been confusing since the June ruling, right? Where they made many changes to the multifamily marketplace. So cap rates have been lagging there, and now I think it's only gotten worse. Our appraisers can't go out into buildings right now. There was a point at one, we just got a notice from the regulators that they don't even have to get appraisals, which I don't see how that would work, but we are still getting appraisals. There was like a moratorium on appraisals if you wanted to do it. What we've been lending on are cash flows. Prior to the COVID, it was 130 amortizing coverages. That would generally become a 65 to 70% loan to value, 65 to 75%, depending on the asset class, with commercial being closer to 65, multifamily being higher. The problem that what we had looked at prior, which is now changing, is we were looking at which tenants could pay rent. So we weren't worried when there was a Panera as the ground floor tenant. Today, Panera is not open, potentially, from what I read in the Wall Street Journal, not paying rent, even if they were able to, on a smaller business. So reliable companies in our portfolio on the loans, are just having difficulties. And I think it's going to, as Shimon said, go into the third, fourth quarter. I do believe tomorrow, if the nail salon's open, the ladies will go get their nails done, and everyone wants to get a haircut except for Shimon. And people will go back. We may go back to restaurants where there are less tables, but are you going to run to the gym? Are you going to run to the movie theater? I think that's just going to take time. So that's the concern we're having in the portfolio. When people came to Signature Bank, they had options to go to CMBS. They had options to go to insurance companies. They had options to go to other banks that I compete with, commercial banks. And they came to me, paid a higher rate, but they paid so that they could deal with us and have somebody to work with them. So our staff has been spending the last month basically on the phone daily with clients. How can we help you? What can we do about this? What can we do about that? To be there for our clients. So cap rates are one portion of it, but at the same time, there are a lot of other variables. A lot of it comes down to debt service coverage ratios, and a lot of it comes down to knowing your clients in the banking world.
I think that's a very good point, Michael. And I think I wanted to add that moving forward, we'll look a lot more at cash on cash returns than just cap rates. Because if you have a unit that's a rent stabilized unit and you're not really able to increase the rent moving forward, and now you also have a collection problem, the only thing you have is your current return. And that's going to go for rent stabilized multifamily. That's going to go for free market unless you have a substantial value add. So the discussion about cap rate is going to revolve around what's the borrowing rate, what's the amortization, and what is the cash on cash at the end of the day. So that's something that we should keep in mind.
I have a question for Joe again, because he's the lender, and I think it's important that people don't hear, they hear hearsay on the street on what's happening. When people are doing a new loan today with a client that you may have been doing business with, are you asking for, as certain other banks are asking for, an escrow of 3 to 6 months of principal and interest to be held for a certain period of time, or are you not asking for an escrow?
So every commitment that we had out there, we've closed. We've gone back and made some modifications where we know, it's very hard in all of real estate to have a paintbrush that one size fits all. So you could have a multifamily building that's completely Section 8, and we know that they're paying rent. So we know that we're not as worried that, with collections. The same building across the street could have 40 apartments and 10 retail stores, and we know 7 of the 10 retail stores are now closed because of COVID. So each scenario we look at, we say to the borrower, we want to close your loan. We want to be there for you. What can we do to make this happen? So in some cases, I had one yesterday where we took 6 months worth of just interest payments, a static interest reserve. And if he demonstrates good collections in January of 2021, he'll get that money. In other cases, we know that it's a retail building and it's a 60% loan to value pre-COVID, but most of the tenants are gone. We've asked them for a guarantee until the property is, restabilized. So we want to be there. We want to work with the clients, but we also can't just have, our eyes closed to the current situation. So each scenario we look at, we are issuing new term sheets. We haven't stopped lending. There are banks out there. I've seen letters that customers have gotten saying, we're so busy with forbearances, PPP, that we are not acting on your signed term sheet. I don't want to be that lender. We want to be there for the clients, but we do need to have protections in there that, we can't just sit here and say, well, the world is perfect.
Here's a question for both Ty and Nadir. What percentage of your retail tenants paid their rent during the month of April, and how many of your retail tenants have come back to you asking you for a deferral of payments for a period of time? Nadir?
Well, I'll say retail is a rather smaller part of our operations, but as you know, no office building exists without retail. So we do have some struggling retails that business has been disrupted from the shelter in place, and we're working with those businesses. So it's been a large percent for the small businesses that we have that are attached to our commercial offices as the retail exposure. And I think that's the first place where that's not an easy business to transition. If you are a professional services company, you easily transitioned 100% of your workforce off. And as long as the technology can accommodate the needs of the business, you're able to transition the workforce off almost seamlessly. But for retail, they can't, right? They rely on the footfall. And so whether it's for proper retail like malls and other, retail outlets that are going to be hit hard by this, that's not dissimilar to what's happening to our retailers that are part of our commercial office space.
Ty?
And I don't have any retail on the portfolios that I've acquired. So, as far as generally for the firm, that's not something that I'm part of right now. So I'm not sure.
Joe, what do you see on retail?
Again, it's a tale of two cities, depending on the tenants that we had thought would pay, the credit tenants per se. And there's always a joke of, Caldor was a credit tenant and so was Kmart. And those type of tenants. But we're seeing tenants that can pay are not paying. We are hearing from owners there was a sense of optimism in April because some of them paid April because that was the March collections. And a lot of it, as we were talking before, might be auto debited from the tenant's account. But I would say in the last 7 to 10 days, we've had calls from large retail operators saying, I'm not sure what to do. I can't even find these tenants. He goes, I know, one guy said to me the other day, I know this Italian restaurant. I've had him as a tenant for 25 years. If I wanted to go see Vito, I would just go to the restaurant and Vito was sitting there. I can't find Vito today. I don't even have his cell number. Those are the situations that we're seeing. We're trying to work with the clients to give them forbearance options for up to 90 days. to get them time to catch up. We are encouraging all of our clients to work with the tenants. A lot of these tenants are also clients of Signature Bank. So, it helps in all different scenarios. We've had conversations with borrowers that today is not the time to get rid of that low market tenant that might have been a pain in the neck a year or two ago. You don't want to have a vacant storefront. Work with them, cut rents in half, forbear some rent, and try, and I do think as these tenants reopen in the third, fourth quarter, it's going to have to be on some of these scenarios, percentage rent going forward.
So here's the question with regard to deferrals both on the loans and deferrals with regard to tenants in your buildings, Nadir. If you get a deferral for 3 to 6 months to an individual, are you adding it on to the lease term, or how are you looking at it? And then Joe, in a similar manner, if you're giving someone, which you can, a 3 to 6 month deferral, where are you looking for them to pay it back? Nadir first.
So there's no one size fit all to working out what is the best resolution for our tenants, which is our partners in a lot of instances. So some people just need short-term relief until the SBA programs kick in, and the PPP program allows them to apply for the loans that then will apply that relief valve that they need to just pay their rent. So some people just truly just need a short term, and they're saying, listen, give me 2 to 3 months, and then I'll start paying it back then over the balance of the year or over the next 3 months. And in some instances, we'll have to tack it onto the back of the lease and extend it. So I think each instance that we're discussing rent relief will be unique, and it'll be catered to that specific tenant's needs and how we can make sure that we are here to provide the right relief and solution for them to make sure that this short-term impact, we can best help to provide, a soft landing.
Michael, we have a question from the audience about the lingering effects of COVID-19. What do we think are going to be the most instrumental lingering effects of this crisis on commercial real estate? What's the good, what's the bad? I'm curious myself to see what people think about this. Nadir, Ty, Michael?
So on the commercial side, I definitely think there's been a heightened awareness around densification, right? We've densified to a point that is really, really extreme. And so I think that will start to be peeled back. Health and wellness. People will start to certainly think about more of adopting better systems in the building that allow for circulation, more technology that allows for touchless elevators, doorknobs, faucets, all kind of things like that. And then there may be items that are integrated that allow for maybe one-way traffic and start to do things like that, right? So I think those are things that could start to come into practice and then actually become the normal way that people feel health and wellness at buildings and how they operate. And so that's some items that could sort of stay around, I think.
So, see, here's a question. Do people believe that more people, since people have been working from homes right now, will that continue in the foreseeable future? Or do people want to be together in their office, with the social contact to discuss things? Anybody else?
This is a personal opinion here, right? Because it's hard to tell. Some of this is going to be corporate decision making by saying, listen, there's certain people from the back office to the middle office that we can reduce our footprint and they can permanently work from home. And there's other people as front office folks that have to be in the city because a part of their deal, a part of their job is meeting with people and to make those deals sort of progress in a way that it works. They need to kind of be in the office and be at a location. So I think some of the decision will be made for folks. But I think everybody universally actually probably has a greater appreciation for them being in their office after being in their work from home situation for some time. It's just different about breaking up the day with the monotony of your commute, no matter how short or long it is. Going to an office, having lunch with your colleagues, having a drink with your colleagues. I mean, I know there's a lot of stuff that's sort of proliferated around virtual cocktail hours and things like that, but there's something to be said around just having that human interaction, and I think people can appreciate it. It's just how do you incorporate now the health and wellness features within an office that actually helps people to feel from a psychological perspective that they're not at risk or anything anymore, now that that's been elevated around, you know, social distancing and the density that New York City has in itself.
Anyone else want to address the point? Ty?
Yeah, I mean, I wrote a couple things down earlier just when I thought of the word COVID, and I came up with 7 things, but I think a couple that are relevant to your point or the question were, will this be like 2009? Shimon rattled off a couple numbers about 2009 and what will the effects of that be? Bank debt. I think that bank debt's really going to be what determines asset prices right now for developable land and for existing properties. Like the way that things were financed before, I think Joe alluded to it a little bit, are going to change, and that's going to affect what we can pay, and that'll reduce that bid-ask spread once sellers realize that part of the reason we were able to pay what we were able to pay before, I think in most asset classes, was because of the ability to have the debt structures, and I think that's changed. Waving the white flag, or some owners, and I think I'm talking specifically about the anyone's got a considerable portion of rent stabilized units within their properties. Are they just going to say that, you know, what's going on with Albany in June last year, and you know, the fact that people are talking about not paying rent for a year, rent strikes, so they're just going to say that I'm done, and if their basis is low enough, can they just move on and starting to do a 1031 and working with someone like Shimon and his firm to try to figure out a 1031 exchange? And then what's going to happen with supply in 22 and 23? If we stop building for the next year or two because of financing and some other things, that means that there's not going to be a lot of supply of new product coming online in those years. So are some developers going to move forward now and try to have one of the few buildings that open up then? And what's it going to do to the existing stock in those years once there's not new supply coming on, but the demand, I think, will continue because we are New York City. So more people will want, and there'll be less units. So what's that going to do for pricing?
Ty,
Yeah,
you bring up
I think Ty is absolutely right when it comes to free market multifamily. I think that you'll see pressure on rental pricing because lack of supply. And I think that market will do extremely well in 2021, 2020 moving forward. You're absolutely right. It's right on.
What about this discussion? I know, Joe, we were talking the other day about this potential rent strike. What's your thoughts about that? Anyone have any comments on that?
Well, I'm hoping it doesn't happen, but you know, I think the governor and the mayor have both been negative on it. I know that the tenants are looking for, there has to be some sort of solution from the government where tenants are experiencing financial difficulties and that landlords shouldn't have to shoulder all of that financial difficulty. Yes, it's great that the tenants don't pay, but these landlords, we all know, have to pay the taxes, the water, the sewer, and then me if they have a mortgage. So I'm hoping that they come up with some sort of voucher system or some sort of plan to help the tenants. We're hoping also with all these different government regulations or the PPP program, which we could talk about a little bit more as well, these tenants will have some sort of solution to, you know, be able to pay their rent. You know, I think someone said the other day on one of your shows that, you know, I'm a landlord, I'm not a 501c3, right? So it's not a charity. We do need to pay money.
And Michael, I think that's an important one because, you know, will there be vouchers coming from the state or from the federal government to help support some people that need COVID? If there's a rent strike, is it really people that are affected by COVID? That's one group of people. But then there's another group of people that just aren't paying rent. I've been reading some articles about some of the people behind the rent strike that are saying that this is an opportunity to fight against landlords. They're not talking about COVID. So I think those are two different topics. And then one of the things that I'm thinking about a little bit forward is what does this do to agencies like HUD? Like HUD does not have unlimited money. I don't know if any of this money from COVID Bill 3.5 or COVID 4 will go to HUD, but I haven't really heard that much about that. And then what does that do to vouchers? Does it mean that the amount of vouchers are actually going to drop or the percentage of rent that gets paid gets dropped for agencies like NYCHA who provides, individual tenant vouchers. So there's not an unlimited amount of money to cover this. And I'm interested to see how that plays out, because it could cause some disruption in places that people aren't thinking about.
I have a couple more questions before we finish. Nadir, with regard to your office tenants, how many have come to you and asked for deferrals? I mean, because you have Class A office buildings with Class A tenants, what percentage have asked for a short-term deferral or not?
We have a ton of tenants, so I can't rattle off the exact percentage.
No, but in general.
There's been a decent amount of dialogue going on there. And we expect that to tick up because shelter in place didn't occur until mid-March. And so the disruption on people's business wasn't really felt on paying April 1st's rent, but maybe over April to May, there was further disruption. And so those conversations we expect to tick up over the coming days into May as well, and it increased. But it's certainly significant, right? People are looking for a relief valve, and tenants are coming to have the discussion around how can landlords sort of, partner with them to provide that relief valve during this time.
Okay, I had asked Joe a question before, and it hadn't been answered because we went into another question. What about people that you've been giving a deferral on both at principal and interest? When do you want to, what are the terms, or how are you trying to look to get paid back on that?
So the principal accrues to the end of the loan or when the loan pays off. So it would just basically be like offering someone interest only for a portion of the loan term. The interest is basically a separate loan to the borrower for that period of time. They could either, we're not charging interest on interest. They could either pay it off if they desire during the loan term, or when you pay off the loan or refinance the loan with us, there'll be a line for COVID interest. So we're not, I know there are like some single family lenders and some others that, sign up, don't pay your Wells Fargo loan, and tomorrow, in 90 days, you have to pay all that money. That's not the case at Signature. You'll be paying it at maturity. So, it's really forbearing it, and it's hard to say because our loans, have all different various terms. So it's hard to say exactly when we will see that money.
Michael, one of the questions from the audience is regarding the type of recovery we'll see, and specifically, do we think this is going to be a V-shaped recovery, at least in the multifamily sector or in the real estate market as a whole? Any thoughts, guys?
It's hard to say that at this point when you have the economy shut down, right? So the economy, there are some states that are activate certain cities and trying to determine where the hot spot is at. But I think until you fully get the economy back up and going, you find a way to do mass testing and a vaccine, then you can start to project around when you think we're going to hit a turn, because now you've gotten the economy going in a way that's supportive to people's health. Until we solve that issue, this is unlike any other crisis we had before. Until you solve that issue for people's well-being, it's going to be hard to say that people want to just go to the movies, go to just any things that we just normally did as a discretionary basis, the mall to shop, even though people can have their speculations on whether malls are dying or not, but people still went to the mall for the experiential side of things as well. Well, people have huge trepidations about doing any of that kind of stuff. So if it isn't moved by necessity at this point, go to the grocer. If the economy opens up in some modified way in mid-May or June or something in New York City opens up, go to work, because I have to go to work now because, my office is opened up and they deem me somebody essential that needs to go to work. But leisure stuff, that's going to be largely on hold until people are confident that they can start moving around in a way that is safe.
This is totally different. 9/11 happened. A couple of months after 9/11, people felt a little more comfortable. They went to downtown. They went to restaurants. They felt comfortable. 2008 happened. It was a period of time that there was a change. This is a totally disruption in our economy. So we have no idea of what's going to take place, how it's going to take place in different markets, because the worst situation is if we come back into business as normal and then people get sick again, we're going to get back into a worse recession than we could be over there. Any other questions that you have, Shimon?
One more. It's about universal rent control. Clearly, the good cause eviction bill is out there. What do you think? You think this is happening this year, or it's deferred for next year?
I think it's deferred for next year.
What about the, one thing that you brought up about the rent guidelines? Do you think there's going to be increases approved by the mayor?
The mayor doesn't decide; he can just recommend.
Yeah, but he puts the board together. Okay.
Right. I unfortunately think that if there's going to be any increase, it's going to be a minimal increase.
Yeah, I agree with Shimon.
Okay, I'd like to thank Joe, Nadir, Ty, and Shimon, and the entire Ariel Property Advisors for putting together Coffee and Cap Rates. Hopefully, we'll see you face to face for the next edition of Coffee and Cap Rates. And thanks
Thank you
again.
very much, Michael. Thank you for everything.
Absolutely.
Bye.
Thank you, and everyone be well and safe.
Be safe.
Same here.
Absolutely.
Agree with you. Bye-bye.
Thank you all.